Now, the next few weeks are fairly crucial for market direction. Some key events to take place are, of course, the US Federal Reserve Chairman Ben Bernanke's speech at Jackson Hole on Friday, the German vote of the European Stability Mechanism, and the potential quantitative easing by the ECB. That's to name just a few. For more, Sam Houlie, portfolio manager of the Momentum Value Fund, joins us from our Cape Town studios. And Sam, let's just start right there. Obviously, in lieu of Jackson Hole almost upon us, what are your thoughts? Are we going to see anything radically changing the global environment in terms of short-term news flow?
Well, it's very difficult to tell exactly what will happen. I think if there's one thing that's clear, is that the markets have in fact anticipated somewhat that Ben Bernanke at Jackson Hole will say something to the effect that, that there'll be another quantitative easing or some sort of stimulus package. Now, if you remember, if you go back 2 years ago, 2010, at Jackson Hole, we had QE2, which was a great surprise to the market. And now I think the market has become very accustomed to these sort of things, because a year ago at Jackson Hole we had Operation Twist. And in fact, I'll probably be very intrigued as to see what the next one will be called, if that. But we don't know. But one thing's clear is that the market has held up incredibly well relative to fundamentals, and I think it's expecting some sort of package. So I would say I'd be surprised if there wasn't a package or some sort of stimulus measure. The market's discounted it. And if it doesn't, I think the market has some downside.
We've just had a conversation with Linda Eads from ReCM, and obviously thicken the value manager side of things. Big exposure on the platinum side, Anglo Platinum being their biggest holding, but exposure across all three. So Anglo Platinum, Lonmin and Impala. In light of the current news flow, have you been accumulating? And let's start with Lonmin.
Yes, I think that, in fact, Lonmin's interesting, but I think the entire sector is interesting. So remember, you've heard me say this many times, and I think we know each other well, that as a value manager, as a contrarian manager, you're always attracted to sectors that have done really badly and where there's a lot of headline risk. In other words, the news flow is really negative. Investors are typically very scared, and for good reason. So all of the platinum stocks fall into this pot or in this sector, and Lonmin is just one of them. I would say that the entire sector is interesting, but you have to be very discerning in terms of which ones you buy and how much of it that you buy. Now Lonmin obviously is concerning because of a few reasons. The first reason is everybody seems to be very clear that they will breach their debt covenants, and therefore an equity raising is imminent. And as an equity investor, that you will be diluted. Now, that is, of course, a possibility, and that's always a possibility, when debt covenants are breached. But if you look at Lonmin's balance sheet, it is clear that there's a whole lot of other things in there, and the discount that it currently trades to its book value, which is just an indicator, not the indicator, but an indicator of cheapness, means that Lonmin is an attractive stock at this point. And so is all the other platinum counters. Now, you've mentioned Amplat, you've mentioned Implat, you've mentioned Lonmin, but we have Northam, we have RBP, Royal Bafokeng Platinum, and we have Aquarius Platinum. So in fact, you should look at the entire sector, and they all are attractive, and all you really need to decide is what your risk profile is and which ones you want. I would say one more thing, Bronwyn, which is very important, is that while the sector is cheap, market timing is impossible. There's not a single person in the market that can time well. So you have to be very clear as to where the downside is relative to the upside. And really, it certainly appears as though it's a good time to invest now, but you never really know that where markets will bottom. And I would imagine that you'll probably be averaging down on all of these stocks. And hopefully this is the bottom, but you're probably averaging down.
Sam, what about the other mining shares? What about Anglo's Billiton? Is the mining cycle finished? Are they just going to stay at these very low ratings because no one believes we can get a recovery in the commodity prices? Or do you think that the valuation difference between resource shares and certain industrial shares is now just too wide and you have to take advantage of it?
Yes, I think the key point there really is that if you just step back from the market, it's pretty clear that the market's been led up by financials and industrials, and that resources have lagged. But having been in the market a long time, these particular divergences, they can last for a very long time. And if you look back over the last 20 years or 30 years, resource stocks have in fact gone a lot lower. So I'm only saying that to say that it's very hard to tell. But if you look at resources, the reason I like it more than the industrials and the financials is I think that a lot of the bad news is out there. And in platinum, I can safely say that I want to be exposed there. But when you look at the other areas of resources, things like the base metals, particularly copper, and iron ore in particular, you got to be a bit more careful, because what platinum has in its favor relative to the likes of iron ore or base metals is that the market's already priced in supply disruptions and a glut of supply. And also some combination of demand disruption. So when you add it all together, I think there's a lot more downside in anything that's directly exposed to iron ore and to a lesser extent copper and base metals.
Sam,
so to answer your question on resources, I'd say it's not a case of where you want to be, it's where don't you want to be. I definitely don't want to be in iron ore and iron ore related stocks that have gone up while the commodity itself has gone down quite a bit. So I'd rather be in the area of platinum, where I think the market has rightfully priced the negative outlook on supply and particularly demand. So
Sam, I just want to jump to...
Resources are interesting, very interesting.
I want to jump to Old Mutual, which is the fourth largest holding in your portfolio at around 4.5%. Just in terms of Old Mutual, hasn't the value unlock already happened? How much more upside is there to Old Mutual? It's interesting that as a value manager, it's such a big holding of yours.
All right, I think, thanks. You're probably looking, we disclose our holdings on a quarterly basis. And I took over the fund in early July. So I'm the new manager of that fund. And I can say that Old Mutual is no longer in the fund at all. So we've sold out of it completely. I'm very overjoyed that, the stock has performed as well as it has. It's been a wonderful time to sell the stock. I think the outlook's great. And I think I've been on the show in the past, particularly February 2009, when Old Mutual would have been my biggest position. And at that point, I thought that the stock was very attractively priced. I think that fundamentally things are going well, but the stock has discounted all of that.
You see, I know you, Sam. It stood out.
I don't have it in the portfolio at all.
Exactly. I know you well. It stood out like a red herring in your portfolio. You're right. The fund fact sheet we're looking at, 30th of June, 2012.
Let me be caught. Sam, when do we sell the banks now? I mean, we've had a wonderful run. 2 years ago, the PEs were incredibly low, begged everyone to buy the banking shares. No one was interested. Whereas now the banks are the new retailers. Is it time to sell, or do you think there's still a little bit more to go there?
Yes, it's always very tough, because I think that if you think of our banking industry and our banking sector, I think it's a bit more of an oligopoly. Okay, that's always a tough word for me to say, but in South Africa, so in some sense, you have a bit more stable profit streams for banks. But the banks have done incredibly well, and they're not as cheap as they were. My feeling is that I'm very wary of the banks, not because of their fundamentals, but more because the prices have done so well. And they have performed in line with consumer shares in South Africa, particularly the retailers. And they have been seen as a proxy for retailers, but I'd imagine that foreign investors have looked at our South African banks and said, well, relative to banks globally, South African banks, Australian banks, they're a good place to be, because they definitely have a higher level of earnings and a higher level of visibility in terms of earnings. So I would say the banks, I have the lowest weighting in banks that I've had in a portfolio that I've managed for the last 3 years. And that's not because I don't think the fundamentals are bad. I simply think that other things are more interesting. So I would say that the banks are lower. It's the lowest weighting. I mean, I can't believe it. 3 years ago I was saying buy banks, hold banks, and today I'm saying, well, I can find value elsewhere.
Sam, before we go,
I haven't sold it because I don't like the fundamentals.
We've got 20 seconds. What's the most exciting thing in your portfolio at the moment?
I would definitely say platinum.